Today, another bank goes negative on housing. Hello again, I'm Martin North from Digital Finance Analytics. Another bank has now changed its tune and is forecasting a fall in home prices. Gareth Aird, senior economist at CBA, says that Australian residential property prices have fallen over the past 6 months, and additional declines appear likely over the next 1 to 2 years due to a further tightening in lending standards, a continued lift in supply, potential higher mortgage rates, and more rational price expectations from would-be buyers. But he says a hard landing looks unlikely, and it is not their central scenario. Stepping through the arguments, he posits first dwelling prices go through both long-run super cycles as well as shorter-term cyclical trends. The recent evidence suggests that Australia's latest residential property short-run cycle has come to an end. And after a little over 5 years of incredibly strong property price growth, driven by Sydney and Melbourne, dwelling prices have been deflating. It is our view, he says, that prices will continue to deflate over the next 1.5 years. Credit standards are likely to be further tightened, supply will continue to lift, mortgage rates are more likely to go up than down, and buyer expectations have adjusted downwards from exuberance to more rational levels. But he says, we do not expect a hard landing, however. Population growth, driven by net immigration, is expected to remain strong, and rental growth is still positive, which ensures yields look reasonable in a low interest rate world. We also expect, he says, the unemployment rate to gradually drift lower, which means that the risk of a default is low. Given that household debt sits at a record high relative to income and the RBA cash rate is at a low record rate, there is also a valid question as to whether we are also at the end of the property supercycle. That is, the capacity for dwelling prices to inflate beyond growth in incomes, as has been previously the case. As interest rates can't go much lower, at least not in the material sense, we are unlikely to see the sort of growth in dwelling prices over the next 30 years that we did in the previous 30. He shows that the long-run property supercycle, as identified by the BIS, shows Australia as having the longest-running housing boom, 6,556% over the past 55 years. But what will happen in the short run? He says their quantitative analysis of the market, overlaid with qualitative views, lead to the conclusion that further falls in dwelling prices nationally of around 5% looks probable, driven by Sydney and Melbourne. Dwelling prices in the 8 capital cities combined fell by 0.3% in April. This was the 6th consecutive monthly fall. Dwelling prices are now down 0.3% over the year, the first time they have declined in annual terms since 2012. Units have generally been performing better than detached houses. Over the year, unit prices were up by 1.9%, while detached houses were down by 1%. Units are generally cheaper than houses, and the bottom end of the market is holding up better than the top. That's in part due to first-time buyer assistance measures in New South Wales and Victoria that came into effect last year. Price falls in Sydney, and to a lesser extent Melbourne, have been behind the national move lower. Dwelling prices in Sydney have fallen for 8 consecutive months. They are down 4.3% from their peak in mid-2017. Sydney dwelling prices rose, of course, 75% between early 2012 and mid-2017. So with that perspective, the current deflation has so far been quite mild. Prices have fallen for 5 consecutive months in Melbourne. But why are prices falling? To better understand why dwelling prices have been falling, it's helpful to look at why prices rose so much in the period from early 2012 to 2017. We start with monetary policy, because the decision to cut interest rates had the biggest impact on property price appreciation. Between November 2011 and August 2016, the RBA slashed the policy rate from 4.75% to a record low of 1.5%, 325 basis points. Mortgage rates fell as a result. Each interest rate cut essentially meant that for a given level of income, a borrower could service a bigger mortgage, all else equal. And it also meant that the yield on property looked attractive relative to term deposits as the return on cash fell. Falling interest rates stimulated demand for property, both from owner-occupiers and from investors. It encouraged a lift in the flow of credit, and that helped to push up dwelling prices, particularly in Sydney and Melbourne. However, it wasn't just a domestic demand story. Demand for Australian property, particularly in our two largest cities, was augmented by foreign buyers. As a result, three sources of demand were putting upward pressure on prices at the same time, when supply was relatively constrained and struggling to keep up with population growth. Some, but not all, of these dynamics have started to shift, and that has put downward pressure on prices. First, the RBA's policy rate has been on hold since August 2016, but some regulatory changes introduced to slow the flow of credit to investors, as well as growth in interest-only lending, has resulted in higher mortgage rates on some types of loans. These higher mortgage rates have dampened the appetite for credit amongst investors, and that is weighing on prices, particularly in Sydney and Melbourne. Second, supply has lifted and dwelling investment has caught up to underlying demand. Third, foreign investment in Australian property looks to have waned a little. State government stamp duties levied to foreign investors rose to between 7 and 8% in both New South Wales and Victoria in the middle of last year. This has had a dampening impact on demand. 4, momentum has shifted. But how far will prices fall? Forecasting economic outcomes is an inexact science, and forecasting property prices is particularly challenging because there are so many variables that impact prices. Notwithstanding, he says, we believe there is enough evidence to suggest that property prices are likely to head lower over the next 18 months, particularly in Sydney and Melbourne. First, momentum has slowed. Like most asset markets, momentum is a powerful force. It has clearly shifted down, and the euphoria around real estate has waned over the past year. The Melbourne Institute of Consumer Sentiment provides a quarterly read on what households perceive to be the best place to park savings. In March 2018, the latest available, just 11.4% of households surveyed nominated real estate as the best place to put savings. That was just off its lowest level in 44 years. Second, credit growth will slow further if we see any additional tightening in lending standards, which at this stage looks more likely than not. From a financial stability perspective, a tightening in lending standards is not a bad thing. But timing is key. Any potential tightening at a time when momentum is already coming out of the housing market would put downward pressure on prices. Third, auction clearance rates have moved lower. In the past, auction clearance rates have provided a good near-term guide to price direction and magnitude. Fourth, supply is rising significantly in Sydney and Melbourne. The recent trends in the building approvals data points to dwelling commencements and completions running at elevated levels over the next few years. Our base case, he says, for property prices is for them to drop between 3 and 6% in Sydney and Melbourne by the end of 2018. That would take the fall in Sydney prices from its July 2017 peak to around 7.5%. For Melbourne, prices would be down around 5% from their November 2017 peak. Some further dwelling price deflation looks probable in 2019, and we see the peak to trough being around 10% in Sydney and a little less in Melbourne. For Brisbane, we see prices trending sideways over the next 1 to 2 years, and dwelling prices likely to inch higher in Perth as vacancy rates decline and rents trough. Nationally, he says, we think prices will end the year down around 2.5%, with a similar outcome likely in 2019. That would mean the total correction in dwelling prices would not be too dissimilar to the corrections in 2010 and 1989. And as always, context is key. A fall in prices in Sydney of 10% from peak to trough would take them back to their September 2016 levels, and a fall of around 7.5% in Melbourne from peak to trough would take prices back to the December 2016 level. He says, we don't see prices softening much in the other jurisdictions, as they simply didn't experience the same growth in prices in the prior 5-year period. But why not a crash? A crash would be broadly defined as a fall from peak to trough around 20%. Many international observers and a few local ones expect this result, but they say that would be a significant correction and would require a lift in the unemployment rate or materially high interest rates. We see neither outcome in our central scenario. We see the unemployment rate as more likely to drift a little lower from here, while any tightening in monetary policy is likely to be very gradual. In addition, Australia's high population growth rate, which is driven by a large intake of around 200,000 migrants each year, looks set to continue. And so despite concerns being raised about Australia's strong population growth, there is bipartisan support from both major political parties to run a big immigration intake each year. And this props up the underlying demand for housing and has kept a lid on vacancy rates in Sydney and Melbourne, despite record levels of dwelling investments. In fact, as dwelling commencements edge lower, policymakers may revert to talking about a housing shortage, given the sheer growth in the number of people living in both Sydney and Melbourne. And finally, rental growth remains positive in Sydney and Melbourne. And he says, we don't see rents falling in Sydney or Melbourne without a lift in vacancy rates, and that does not appear likely without a change in Australia's immigration policy. As such, rental growth is expected to remain positive in Sydney and Melbourne, which provides a natural floor on how far dwelling prices can correct lower. Finally, he turns to the impact on the economy and monetary policy. Changes, he says, in dwelling prices have an impact on the spending decisions of households via the wealth effect, the notion that changes in demand are influenced by changes in the value of assets. The theory states that when the market value of assets rise, it leads to the feeling of being wealthier, which should encourage spending and reduce savings. In Australia, the falling savings rate is evidence that a wealth effect has been in play. Now, it may be the case that the savings rate declined simply so that households could manage a modest level of consumption growth in the face of falling income growth. But the point to note is that firmer dwelling price growth gave these households that own property greater scope to reduce savings, given their balance sheets were optically strengthened. Certainly, there is a high likelihood that the reverse would be true and households would rein in spending if dwelling prices were falling. Now, my own view remains that property prices have further to dive as tighter lending rules bear down. But I do find it significant that CBA, the biggest owner-occupied lender in Australia, has now also gone negative on housing. We think that more will follow. If you like what you've seen here today, please like the post and add a comment or question. I do read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now and ring that bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.